everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, thanks again for tuning in to our latest market update and outlook. This is for the month of August. It's been, again, another busy month. We're going to talk about the latest with inflation, what's going on with the Fed. Of course, I'm going to get into my outlook and a revelation that I made in doing some research last month. So I hope you guys enjoy it. Get to that one of the last slides there where I talk about this revelation, and I hope you guys enjoy it. I hope this is helpful, and thank you again for watching. Alright, so here are the asset class returns for the month of August and year to date. The blue is for the month of August, the green is for year to date. So as you can see here, these are not pretty charts. Year to date, we're down pretty good. For the month, we had a negative 4% for the S&P 500. I label as large cap stocks, small cap stocks as well. Real estate was down a little bit worse, down about 5.5%. Developed international was down about the same as the domestic stocks. Emerging markets actually had a slightly better month, but they've been down quite a bit also year to date. Looks like maybe China's trying to stimulate what's going on with their economy. We'll talk more about that in the update. Fixed income, the high quality fixed income, down again this month. As you can see, quite a bit year to date. This is actually one of the worst bond markets we've experienced in probably the last 40 years. Usually when stocks are down, bonds are at least flat or up a little bit to act as a counterbalance. But this year, because of the Fed raising rates so aggressively, that's really hurt the bond market. You see the same thing with high yield down as well for the month and for the year. Commodities has been one of the few bright spots. Again, we've had exposure there, thankfully, so that's helped. It was down a little bit for the month, but still up nicely for the year. Again, saying that commodities were down for the month is not such a bad thing. That means inflation is starting to get a little bit more under control. So you would think the market was up, being that commodities were down, because it's all about inflation, right? But again, we'll talk more about the Fed and what they recently talked about in their last meeting, which was a big catalyst. So those are the asset class returns for August. All right, quick update. First, let's take a look at how inflation has been doing recently. I wanted to show you this chart here on the right. This breaks down the CPI into the monthly increments. And the reason I wanted to show you the monthly is because I wanted to highlight that the last month actually was 0. And so this is a big change from the June number. And it does look like maybe August could also be a promisingly low number. That's why I have this real estate person pictured here, because it does look like housing is starting, the housing prices are starting to flatten because sales are way down. Even rental prices are starting to flatten out. I've seen some numbers that look very promising there. So it does look like inflation is starting to look like maybe it peaked and it's starting to come down. We'll see if this can continue. So really, this is the story of the month. It was all about Jay Powell and the meeting they had about 3 weeks ago in Jackson Hole, Wyoming. And so basically, Jay came out and had a very short but very strong speech about how they are dedicated to controlling inflation and getting it down, and basically, figuratively kind of giving a little spanking to the market, because the market, as you remember from July, we had very good return numbers, was already starting to anticipate the Fed maybe getting to the point where they feel like they've done enough to fight inflation. So I think the message here from Jay Powell in a very stern way is that we're not done. We're not even close to being done. And so that message, I think, was a little surprising to the market. and that's what we saw in the last half of the month of August. We saw a correction. Basically, interest rates have been going up for the last several weeks because of this, and the market has been going down, although it's kind of stabilizing here recently. But this is why. So the real question is, do we really believe the Fed is going to continue to be very aggressive even if we start going into a recession? Or are they going to pivot if the market and the economy really starts to fall apart? It does seem like they're very committed, and I do think that it's really going to come down to the data from what is happening with inflation. Again, that's why I'm spending so much time and focusing so much on those inflation numbers. And they do look promising. But I think the message again from Powell is we don't want just 1 or 2 months where it looks promising. We want to see a good while, probably 6 months or so. They haven't said exactly what they're looking for, but probably a good long-term pattern that inflation's going down. And so it could be a little while longer. And I would also add on the market update, we're seeing a development more globally where the world is starting to slow down economically. I got a little headline here from the Bank of Japan, Nomura Bank, talking about Asia, specifically China, and how they're slowing down. China is really struggling right now because they've been locking things down. That's been hurting their economic output. They've also been having some banking problems that we've been talking a little bit about for the last year or so, and they're all kind of coming to a head. We're actually seeing the federal government of China actually stimulating and cutting rates. This is the only place in the world that's doing this right now. They haven't had as bad of a problem with inflation. So they're trying to do that. Maybe that will help. We saw a little bit of an uptick in emerging markets in the month of August, so we'll see if that can continue. But they're definitely struggling, and frankly, Europe is an even worse place. We've been talking about that for months, and they most likely are going to go into a pretty bad recession. So we'll talk more about that in the outlook, but I wanted to bring this up in the update here because there's definitely a global slowdown that's in the works. All right, Demel, enough about what's been going on. Tell us what you think is going to happen going forward, right? Isn't that what everybody always wants to know? So here, let me show you some of the things that I'm looking at. This is a chart from Econ Pie. I look at this chart all the time. They're showing you how all the different leading indicators kind of average. That's what these little red dots are. That's where all the leading indicators, they have like 30 different leading indicators that they look at. And what's kind of cool about this one, this shows you where it's been. You know, this is first quarter 2020 and kind of where it's, how it's been traveling. And the top quadrants are growth. The bottom ones are declines. This one on the left is growing but slowing down, where this one on the right is growing and accelerating. So what you're seeing here is we're still growing, but there's been some deceleration, and usually once you get close to this area, that's where signs of recession could be pretty high. I'm still in the camp that the recession here in the U.S. is more likely than not. The severity of the recession is what is not very clear. I'm still get a sense it's going to be more of a mild recession. We're not as in bad of a shape as emerging markets and the developed international markets. Fortunately, we are the cleanest shirt in the dirty laundry, so that's good. And there has been actually some decent numbers that have actually moved this average a little bit more towards that expansion quadrant, believe it or not. This These numbers are a little bit older. They don't show some of the recent numbers. The unemployment number that was actually still pretty strong. Some of the ISM numbers, they show some leading indicators actually slightly improved. So we're kind of hanging in there, but I think the Fed continuing to push against inflation is going to eventually break down the economy to the point where there's going to be at least a mild recession here in the U.S. Alright, thanks for making it this far in the video. I think this is actually the most important slide that I have on the whole video. So check this out. So I went ahead and broke down the inflation numbers by month. Okay, and I actually did this exercise because I thought I was going to convince myself that we are really far away from getting inflation back to where the Fed is comfortable, which is a 2% target. And it was an interesting development, because what I noticed is that maybe there's a little bit more hope than I thought. So here's the month over month inflation numbers, okay, defined by the CPIU. You can read that. And then, so what you're seeing here in bold is last year's numbers. These are the numbers that are going to start trailing off as we get new inflation data coming in, okay? And these are the ones for earlier in the year. So I did a hypothetical. What if, okay, what if we get zero inflation for the rest of the year, which is again going to be a challenge, but we did do it last month, and it looks like the month of August could also show a very low number, maybe even a zero as well. And so, so if we say that that can keep up for the rest of the year, you can see by adding in those zeros, we end up with, at the end of the year, a 5.66% inflation number, which is still not very good. It still sounds pretty high. So at first this was confirming what I thought, is that this is going to take a long time. Man, the Fed is going to stay aggressive for a while, because at the end of the year, inflation at 5.66 does not look good. But then what I did is I said, well, what happens if we actually start going into next year and inflation just goes up 0.166, which is just 2%, divided by 12. So if that happens, at what point do we reach 2%? All right, 2% on inflation. And so what I show is that basically we are 9 months away from getting to the Fed's goal of 2% inflation if we can keep inflation really, really low. Now, again, this is a hypothetical. I'm not sure this is going to happen. We do have some issues happening at the end of the year where Europe is shutting down all of their imports of Russian oil and gas. There's a lot of issues that could make inflation kind of creep back up again, maybe at the end of the year. But if the Fed actually does produce a recession, and we're talking about global recession in Asia and Europe, then there's a good possibility that we could keep inflation pretty low. And so my thinking here is, if the Fed in December looks back and they see how inflation's been coming down pretty dramatically, and they know that the raising interest rates also has a lagging effect, which means that they maybe could say, you know what, we're going to stop right here where we are, and let's just be data dependent. Let's just see what happens for the rest of the year, because this could realistically go on if they've already slowed things down enough. They might feel like they've done enough here by the end of the year. And if that actually happens, that would be what I call the Fed pivot. It could actually come at the end of the year, and if that were to come, again, the market's going to start sniffing that out a little early, so we could even see maybe the market start to rebound towards the end of the year. That's my hope. I do feel that there's a good chance for that. Obviously, it may not happen, so you always have to prepare for the worst and hunker down a little bit longer than this. But it turned my pessimism into a little bit more of a hopeful outlook, because this looks actually sort of probable, and there could be a pivot coming in December, which means that we could see, again, a good finish to the year and maybe a more promising 2023. All right, so here are the implications for the portfolios that we're implementing here at Heartwood. So basically 3 things. As you can see here, we're continuing to add a little bit more to the higher quality bonds. Again, a little bit of a slowdown, good potential for recession. Bonds tend to do much better. And basically they've been beaten up so much, they're great deals right now. We've been underweighted in the bond area, and now I'm trying to get a little closer to a neutral weighting there with bonds. Second, we're trimming international, particularly the developed market area, mostly Europe. They're going to have a hard time recovering from everything that's happening with Ukraine and Russia and energy. So I think they're really going to struggle, so we're trimming that back a little bit. That's where the money's coming from, mostly for the bonds. And we're just going to continue to rebalance. We're not doing anything super dramatic here, because I do think that we're pretty close to maybe getting to a turnaround. Unfortunately, there could be another month or two, because again, the Fed is going to want to see more low inflation numbers, which haven't happened yet, and they may not. So we have to be kind of careful while we wait for things, but I think they could be turning around here pretty shortly. So we're just going to continue to rebalance. I have been taking advantage of a lot of tax loss harvesting. For those of you that have taxable accounts, you've probably seen a lot of these trades going through recently. Hopefully help you a little bit with your tax situation. So I hope this was helpful, guys. If you have any questions, please feel free to reach out. Just want to thank you for your patience. Thank you for hanging in there with me. I know the market has been pretty tough this year, but as you can see here, things aren't looking super rosy, but there are potential catalysts that will turn things around here for us in the future. And so, of course, I think there are going to be some changes coming. So thank you again. Hope you have a great day. God bless.